Okay, let's jump right into this explainer. Today, we're breaking down a reality that is honestly a little terrifying. Mastering your finances, it's not about building the perfect spreadsheet. It's actually about mastering the hidden biases inside your own mind. We spend so much time obsessing over the math of money, the interest rates, the complex formulas. But today, we are going to look at the silent emotional traps that actually dictate our financial futures.
Seriously, why do incredibly smart people make terrible money decisions? I mean, we've all seen it, right? A total genius goes bankrupt, or your brilliant friend makes a completely disastrous investment. We just naturally assume that if you have a high IQ or read enough finance books, your money is safe. But high intelligence doesn't protect you from emotional traps. It often just hides them. Your choices feel rational because they're yours, but that is exactly where the danger begins. So, here's our roadmap for today. We've got 5 key areas. 1. Money is deeply psychological. 2. The illusion of pure logic. 3. The ego and status trap. 4. Surviving the investing game. And finally, 5. The true value of time. Let's get right into it.
Starting with section 1, money is deeply psychological. Or as I like to think of it, you are not a machine.
Look, spreadsheets don't feel fear, right? They literally cannot panic during a 30% market downturn. But you and I, we absolutely do. You could build the most mathematically perfect, hyper-rational financial plan in the world, but if it doesn't leave room for your own human anxiety, it just won't survive the real world. A plan you can reasonably stick to when things get terrifying is so much better than a perfectly rational plan that you completely abandon in a panic. Ask yourself, does your financial plan account for your own inevitable stress? Because if you expect yourself to act like a robot when your life savings are on the line, you're setting yourself up for failure. Moving on to section 2, the illusion of pure logic, which covers luck, risk, and the comforting stories we tell ourselves. Just look at the story of Bill Gates. Now, he's undeniably brilliant and totally hardworking, but he also experienced a literal 1 in a million stroke of luck. He attended one of the only high schools in the entire world in 1968 that actually had a computer. He had access that almost no one else on the planet had. But then there's Kent Evans. Kent was Gates's best friend, equally brilliant, just as obsessed with coding. Tragically, Kent experienced a 1 in a million stroke of risk, dying in a mountaineering accident before graduation. When you compare the wild luck of early computer access against the tragic risk that ended an equally promising life, you realize a very humbling truth. You can do everything right and still lose. Effort matters immensely, but luck and risk are powerful, silent forces that we often just ignore because they're too uncomfortable to admit. And these wild, unpredictable forces play out in the broader market through what we call tail events. Check this out. Since 1980, just 7% of companies in the broader market index drove all of the market's net gains. The other 93%, they barely moved the needle or failed entirely. This means rare, explosive events dictate almost everything in finance. We're wired to expect outcomes to be normal and average, nicely distributed along a predictable curve. But the reality is that extreme outliers drive the results. Your job as an investor isn't to perfectly predict every single one of those outliers. It's to build a resilient enough strategy that you can survive long enough to catch one. Which brings us to section 3, the ego and status trap, and the very real danger of never enough. There's honestly no more vivid example of this than former billionaire Sam Bankman-Fried. I mean, at 29 years old, this guy had a $20 billion crypto empire. That is more money than anyone could spend in 100 lifetimes. But he risked it all, quietly mixing customer funds just to chase endless status and control. Why? Because the word enough was literally never part of his vocabulary. When you don't define what enough is, the goalpost just keeps moving until it crushes you. It's a psychological treadmill, and the faster you run, the faster it spins, ultimately pushing people to risk things they desperately need just to acquire things they don't even care about. And a lot of that endless climbing, it's driven by the man in the car paradox. Think about this the next time you're stuck in traffic. When a screaming fast, ridiculously expensive Ferrari pulls up next to you, do you actually admire the driver? No way. You just picture yourself behind the wheel. If you're buying luxury items to win admiration, realize this. People aren't impressed by you, they're just using your fancy stuff as a mirror for their own desires. We spend small fortunes trying to buy respect, completely misunderstanding that the people we're trying to impress are way too busy imagining their own success to even notice us. Because the truth is, looking rich is loud. It's the fancy cars, the exotic vacations, and the incredible high stress of keeping up appearances. But true wealth? True wealth is silent. Being rich is about hidden assets, the flexibility to walk away from a toxic job, and the profound peace of mind that comes from not spending money. Spending money to show people how much money you have is quite literally the fastest way to have less of it. We so often confuse wealth with spending, when in reality, wealth is the money that hasn't been spent yet. It's the options you've preserved for your future self. So ultimately, savings is just the gap between your ego and your income. This completely explains why a highly paid professional, someone making $250,000 a year, can still be drowning in debt, living dangerously paycheck to paycheck. If your ego inflates exactly as fast as your income, meaning every raise is immediately swallowed up by a bigger house, a nicer watch, or exclusive dinners, there is absolutely no gap left. Building wealth is fundamentally about needing less ego. It's about actively choosing to step off that lifestyle inflation treadmill and realizing that mastering your desires is far more lucrative than just increasing your paycheck. All right, on to Section 4, Surviving the Investing Game, where we balance offense versus defense. When you get into the market, you absolutely have to view volatility as a fee, not a fine. Think about it. In everyday life, a fine means you did something wrong. You ran a red light, you broke a rule. But a fee? That's just the normal price of admission to a theme park or a show. If you want the massive gains of a company like Netflix, which saw mind-boggling growth over the years, but spent 94% of its greatest growth period trading below its all-time high, you have to accept that stomach-churning volatility is just the fee you pay. Don't let the short-term pain trick you into abandoning your strategy. You aren't being punished, you're just paying the admission price for long-term compounding. To actually survive this game, you need what's called a barbell personality. On one end of the barbell, you're building a massive margin of safety. You're holding extra cash because you fundamentally expect plans to fail, and you need absolute flexibility when a crisis hits. You diversify so a single point of failure won't wipe you out. But on the exact opposite end of the barbell, you are fiercely holding on to long-term optimism. Remember, pessimistic news headlines will always sound smarter. They trigger our deep evolutionary survival instincts and make us want to sell everything. But over decades, it is quiet, persistent optimism that actually generates wealth. And that leads us to our final part, Section 5, the true value of time, focusing on compounding and freedom. Consider this for a second. Out of Warren Buffett's roughly $160 billion fortune, an unbelievable $156 billion came after his 65th birthday. Yeah, let that sink in. Our brains just aren't built to intuitively grasp this kind of exponential math, but it is the truest secret of wealth. We focus so much on trying to get the highest possible annual returns, overanalyzing every tiny market movement. But the real magic? It happens purely in the sheer duration of the investment. He started investing at age 10, became a millionaire by 30, and then he just didn't stop. It's exactly like planting an oak tree, right? In year 10, it doesn't look like much, and you might be tempted to just dig it up and plant a different seed. But by year 50, it's massive, unshakable, towering over everything else. He didn't need secret, wildly complex investing formulas. He just let time do the heavy lifting, over 8 uninterrupted decades. The big takeaway here is that good investing isn't necessarily about making the absolute best decisions. It's about consistently making pretty good decisions for a very, very long time, without ever interrupting the compounding process. So, how do we actually use all of this to find true financial freedom? Well, first, you have to clearly define your own game and your own timeline. Are you investing for a house next year or for retirement in 30 years? Second, you need to loudly ignore financial advice meant for people playing a completely different game. Do not copy a day trader's risky short-term moves if you're a long-term passive investor. And third, realize that the highest dividend money pays isn't luxury items. It is freedom. It is the unparalleled ability to wake up every single morning and say, I can do whatever I want, when I want, with who I want, for as long as I want. So I'll leave you with this one final thought for this explainer. Look really closely at your financial goals today and ask yourself, are you truly playing your own game, or are you secretly playing someone else's just out of a desire for status? What does the word enough actually mean to you? Because once you define that, you don't just master your money, you master your life. Thank you so much for joining me, and keep questioning those hidden traps.